John Williams, thanks for joining me today.
Thank you for having me, Kenneth.
John, let's start off with ISM Manufacturing. Obama promised that he would create 1 million manufacturing jobs by the end of 2016 while campaigning in 2012. Is this what we are seeing?
Well, let me get into the general trend there, because what you find in the way of jobs creation is not exactly as what people normally think of as jobs creation, or as generally as advertised. The production area has been an area that the manufacturing area has been terribly hit over the years, and there's no fundamental improvement there. The big problem has been a general loss of domestic manufacturing to offshore production, with the better paying jobs going offshore. The government has two measures of employment. One is the headline payroll employment. That's the one that gets the big numbers. It's up a couple of 100,000 each month, give or take some. And the only problem is that counts jobs. It doesn't count people who are employed. If you look at the other measure, which is in the what they call the household survey, one they use in calculating the unemployment rate, it measures only the number of people who have a job, whether it's full-time or part-time. And there you don't see quite the same gains. In fact, if you look at people holding full-time jobs, that area has just recently recovered its pre-recession high, and that's more month-to-month statistical aberration than statistical aberration, as opposed to a real improvement in underlying jobs growth. Most of the jobs growth that has been seen has been, and this is from the payroll, not from the side of just counting people who have jobs, but where the payroll, the number of jobs has increased. It is largely reflected increases in part-time jobs, often for economic reasons, where people can't get a full-time job even though they'd like one. And that is not a happy circumstance, and that is not as commonly reported in the press.
John, can you explain what you meant by the payroll only reporting actual jobs? And doesn't that mean somebody being employed if there's a job out there? What was the significance of what you meant by that?
Okay, well, the what's called the payroll survey is counted based on what companies report in terms of people they have on their payrolls. As of a certain date of the month, if someone's worked for a week and received a paycheck, I mean, if they've worked for an hour and they've received a paycheck, they're counted as employed. So what's counted there are part-time jobs. You could have 3 part-time jobs and be counted 3 times in the payroll employment. So what the payroll reflects is the number of jobs out there, although they're not necessarily full-time jobs. The household survey counts the number of people who actually have at least one job, but it doesn't count them multiple times. It only counts them once.
So, John, when in regards to manufacture, you said we're on the decline here. How important is manufacturing for the U.S. economy?
Well, let me put it this way. That's where you manufacture. The manufacturing creates wealth. Trade surpluses create national wealth. We've been in a circumstance for decades now where various trade policies have encouraged very much blossoming trade deficits, and those trade deficits have reflected the much higher paying jobs going abroad. the concept behind free trade, and or at least the theory as to why it works and why it's supposed to be such good news for everyone, is very simplistic, and it reflects the weakness in the economic community not being able to develop functioning models for complex circumstances. To give you an example, the way they'll explain it is, let's say you have two countries, A and B, and country A makes an imaginary product, widgets, very efficiently, but not so much the widgets. And the other country makes the widgets very efficiently, but not so much the widgets. But the two countries don't trade with each other. Now, if the two countries trade with each other, open up free trade back and forth, you'll see activity shift back and forth, and the country that makes the widgets most efficiently will end up making most of those, and the country that makes the widgets will end up making most of those. And as a result, you'll have greater production overall and greater wealth overall, and everyone's better off. That's the theory. Mm-hmm. The problem is there's a precondition to that, and that is that the involved economies all have to be at full employment. Mm. We haven't been at full employment in a long time, and that's generally true of most of our trading partners. So that, for example, when we entered the NAFTA agreement, what happens there is if you're not at full employment, the production shifts to the low-cost producer. So we see production shift to Mexico, jobs were lost offshore. People left behind aren't able to find the type of jobs they had before that pay the same. They end up taking lower-paying jobs. It's a very unfortunate, debilitating circumstance for the domestic economy and for popular optimism and outlook towards the future. It's one reason you're seeing such a tumultuous presidential election year. Problems here have been around for a long time, but everything seems to be coming to a head. And I can tell you that as I've looked at numbers as reported by the government and as most people see them, that I'll take Main Street USA anytime over the government in terms of what's happening. What Main Street USA is telling is that we're in serious trouble, and you've got to have a change.
John, when I look at the government numbers, I see that unemployment is now at 4.9%, and the labor force actually marginally shrunk in January. So the labor force participation rate. So what I wanted to ask you is there something we're missing behind these numbers? Because if I was just to look at these without doing any research, I might think that we're on a positive trajectory here.
Well, that's the headline number, and that's what the administration's posting about. They've cut the they've cut the unemployment rate from its worst level, the headline number, at 10%, down to 4.9%. Actually, a little bit more than half. But that headline number does not generally reflect common experience. The government has actually publishes 6 levels of unemployment. The one that gets all the detail in the headline and as such is called U3. That's their third level. They have a 6th level of unemployment called U6, which is running up around 10%. And the difference between them, and the reason that you have the low number with the U3, is that in order to be counted in those numbers, to be counted in the headline, to be counted as headline unemployed, to be in the headline unemployment rate, you have to have been actively seeking work for the last 4 weeks. If you haven't, let's say you've been looking for 6 months or a year, you've been trying for a year and a half, and you give up looking for work at least for a while, because there are no jobs to be had. They won't count you as unemployed in the headline number.
Right.
If they qualify you as a discouraged worker. Now, if you're qualified as a discouraged worker, they'll continue to count you for a year in the broader U6 measure. But after a year, if you're still discouraged, they drop you from that. And back before 1994, before all the employment numbers and the unemployment calculations were redefined, they didn't have such a definition. They counted everyone who was a discouraged worker, and I still estimate that so that although my numbers are higher than you get out of their numbers, I have a variety of factors that I look at there, and I've been looking at since they changed the numbers back in 1994. As an involvement with an economic pollster who had very good measures as to what was happening there and could tie into the government's numbers. My number right now is up around 23%, just shy of that.
Wow.
Now that includes everyone, because what happens is in the short-term unemployed, where you're at 4.9%, if you become a discouraged worker, not actively looking for work, you disappear from that counting. That's a headline number. That's the good number the administration's looking at. If you've been discouraged for less than a year, you're counted in the broader U6 number, and that's up around 10%. But after that, you drop out of the U6 number. You're still a discouraged worker. But I estimate that number, and again, it's my number, and I've got it up again just shy of 23%.
Yeah. No, and I think people are being exposed to the real number because of you. I mean, even candidates like Bernie Sanders and Donald Trump are actually talking about these higher, more realistic unemployment rates. And I gotta wonder if they're reading the work, or at least coming across the work because of you, because you're out there spreading the word and educating so many people, and it's becoming more of a mainstream conventional wisdom to know that the 4.9% cannot be trusted. So to that extent, I actually want to thank you for doing the work that you do and being out there educating and coming on shows like this and doing interviews and educating audiences out there. So moving on, John, I wanted to ask you about retail sales. Now, we did see this number rise according to their numbers again for January, and I mean, I'll ask you it in this fashion. Is this good news for the economy that retail sales went up?
Well, generally the answer there would be yes, but two things you have to look at. One is net of inflation, because the retail sales numbers are reported just as the cash registers ring them up, and that's fine as long as you know what you're looking at. But economists, when they try to figure out what's happening with the economy, will generally try to adjust for the effects of inflation. That's what they do with the gross domestic product. The idea being that if, let's say, your sales are up 10% year to year, if inflation is up 10%, then your gain in sales has been in inflation, not in actual physical volume of the product you're moving. The numbers used for deflating retail sales are understated. The inflation's understated, so that tends to boost the real number. But we're not talking about the real number here, the real meaning inflation adjusted. We're talking about the headline number that they came out with, and it was up 0.2% this last time around, which is that's on a month-to-month basis. In January, we've seen virtually no growth, including inflation, in some time. Part of that, that tells you there's a problem with the consumer, and even allowing for inflation, it's like because we haven't had much headline inflation because of the continuing drops in gasoline prices. That knocks the headline inflation number down.
Mm-hmm.
But in terms of that 0.2% gain, which is not really meaningful to start with, let me put it this way: it's not statistically significant, as the government expresses it, which means that it could be zero, it could be negative. They don't know.
Mm-hmm.
They can't put a solid, they can't put a meaningful confidence interval around that is would make it significant. So that it's they play with the numbers. Then not only these retail sales numbers, but also the employment and unemployment numbers. And what they do here is they use an approach here of seasonal adjustment, which is called concurrent seasonal factor adjustment. And what they do, the concept of seasonal adjustment is absolutely fine. Really is helpful if you're trying to assess numbers on a month-to-month basis. Because if, let's say, you're looking at retail sales, you'll see, big boom at Christmas time, and then it falls off after Christmas. If you're just looking at Christmas sales, they'd be up. And how do you assess that? The seasonal adjustments tend to smooth it out for the seasonality.
Sure.
And the way they used to do it was they'd look at the last 5 years and they'd work out seasonal patterns, and then they'd apply it to the year ahead, and that worked reasonably well. And then they took it a step further with what they call these this concurrent seasonal adjustment approach, where instead of just basing it on the last 5 years, they base it right up to the most current month. And they revise, they calculate the seasonal factors, including the current month's activity. Now, in doing so, what that does is it revises the history, the seasonal adjustment history, and the actual consistent numbers historically every month going back 5 years, so that whatever numbers you had the month before are no longer the same in terms of it being on a consistent basis. Mm-hmm. And I wouldn't have too much of a problem with it, other than it seems sort of silly to revise the numbers each month if they published a consistent history.
Consistent. That's the key.
Because then you could see what was happening, but they don't do that. They in terms of the retail sales and the payroll employment, that's the one where they count the number of jobs, not the number of people. They'll show you the consistent numbers for 2 months, but before that, the numbers are not historically consistent, so that you don't know what you're looking at. And if the numbers shift, which they tend to do, as they change the seasonal factors, you can see what they're doing with some of the numbers. There's a limited window with the retail sales. You're actually able to get the full mathematical base for being able to recalculate the payroll employment. We do that, and so we can see what actually is happening there in terms of the history. In terms of the unemployment rate, there's no consistency month to month. There's none whatsoever. So that when they tell you that the unemployment rate was up or down by 0.1%, that has no real meaning, because you don't know what they really revised the prior month to. It could have been up or down. They could have reported it up 1%, but it was really down 1% or 0.1%.
It's insane. When you look at the reports that they put out, there is so much they are taking into account, and you can just tell that if they wanted to make a change here and there, that it can very easily be done. When you actually look at these charts, it's insane trying to sit there and follow it and look at the data they have and assume that what they're doing is reliable. And we know it isn't reliable. And I have a friend who actually is a general manager of Sports Chalet, and he says, man, it's just been bad year after year. And this last Christmas, I mean, they cut hours left and right just to be profitable. And even their numbers were still down with all of the hours they cut. They still weren't as profitable as the year before. And they're struggling out there. And it's this economy is having a hard time, and they're having a hard time painting a picture of a recovery. So
there hasn't been a recovery. I mean, yes, they paint it, but again, Main Street USA doesn't show that. Where you see the recovery generally is in the reporting of the gross domestic product, which is very heavily guessed at. And they again understate inflation there, which about 2 percentage points, which gives you all the growth you've seen in the GDP since the economic crash. And what I would contend is that instead of having the official version of the economy crashing into 2009 and then rebounding, right now the GDP is 10% above its pre-recession high. That after the crash, you may have had a little bit of a bounce up, but generally you've been at a low level of stagnation ever since. You've never recovered. Now you see that in certain series, like the housing series, all show that. Durable goods orders show that. Retail sales, real retail sales, if you adjust for the inflation problems, will show that, and the same thing's true with industrial production. Even within industrial production, and that's it used to be the core of the U.S. economy. You have a circumstance where the manufacturing sector, and this is as reported by the Federal Reserve, the manufacturing sector has never recovered its pre-recession high, despite the GDP being 10% above its best showing before the recession. The GDP numbers are nonsense. Mm-hmm. You look at corporate profits, or not corporate profits, corporate revenues. You look at the sales of the S&P 500 companies. Those are real numbers. I'm talking about just taking out the effects of all the buybacks, just looking at the sales of the companies, and you're down quarter to quarter, you're down year to year. You never see that out of a recession, outside of a recession. We're in a recession. We've been in a recession. You look at the industrial production numbers now are down. And this is an aggregate, not just manufacturing, but across the board. You look at them year to year, quarter to quarter, they're down. You never see that outside of a recession. The retail sales, as reported, year to year change is below 2%. That's adjusted for inflation. Normally, when you see that, that's a sign that you're in a recession or going into recession. The housing numbers never recovered, and now they've been flattening. They had some uptrend. They're turning down again. So that the way I would describe the economy is that it never recovered, stagnant for a protracted period of time, and now it's starting to turn down again. And this is why people are feeling so much pain, and why you're likely going to see some a disruption in the normal the political system in terms of the way people view the establishment government policies. It's a very difficult time. Now, you have to. What led to this? Where we're in ongoing trouble here. I wish I could say, boy, things are about to turn around. The consumer is in difficult straits. Generally, income is not up. Average guy's not able to make ends meet. You see the consumer confidence is lower. the lending by the banks has been increasingly restrictive since the crisis. They're not lending the way they used to, and most of the growth that you see in consumer credit is in student loans, which is fine, from the standpoint of the students, but it's not into the areas of activity that tend to stimulate consumer spending.
John,
so that,
no, I was going to say, the headline on Zero Hedge this morning when I woke up said 2016, the year wishful thinking fails. And I think Main Street is gonna feel that, and wishful thinking is gonna fail here in 2016.
Well, again, you talk to Main Street USA, you know what's going on. I'll take the general consensus you get out of Main Street. Again, anytime over the numbers coming out of Washington.
That's exactly right. John, I wanted to switch gears and talk about a philosophical question that I've been trying to wrap my mind around. And I haven't lived under an economy that had a gold standard. So we all ideally want to go back to a gold standard because there would ideally be fiscal responsibility. Now, in doing some research, under a gold standard, there's a limited amount of gold, and if the economy is growing, we would actually see our money continue to go up in value. It would retain its purchasing power, because if there's increased growth in the economy and there's a limited supply of gold, the prices should actually fall. So my question is this, and you can kind of take this as you in the direction you'd like to go, but Keynesian politicians say we need inflation. That's an economic stimulus for the economy. But how would an economy function if there's deflation in the money supply? Or not money supply, but just falling prices? Well,
again, you want to look at how an economy is doing. You tend to back out the inflation, so that if you had an actual deflation, that would add to the inflation adjuster to the real growth. So the economy were contracting, let's say, at 1% per year. The prices were declining at 2% per year. You'd actually be seeing real growth in the economy of 1%. But that's not the problem we have right now. And what's being missed by many here is that the central banks are out of options. They don't know what to do. And they had a circumstance, and I'm looking specifically at the Federal Reserve and the U.S. Treasury in the panic of 2008. Because that's what's driving the current circumstance. You had a circumstance then when the U.S. banking system literally was on the brink of collapse. They weren't kidding people. Without action taken, the banking system would have collapsed. The financial system, as we know it, would have collapsed. You would have seen tremendous turmoil. I think looking at that circumstance, you have to agree with saving the system. I mean, nobody wants that type of a circumstance. We should not have gotten there. We should not have been there. And the reasons that we got there were due to extraordinary debt expansion, living well beyond our means, with the budget deficit out of control. When you look at the deficit out of control, I'm not talking just on a cash basis, but I'm talking about all the obligations that the government's taking on for the future that it never has any chance of covering. Right now, the federal government's unfunded liabilities, net present value, in other words, the cash you need in hand to cover that, and existing debt is in excess of $100 trillion. There's just no way that can ever be covered, which means eventually the dollar becomes worthless, because when you have that circumstance where governments generally do not declare bankruptcy, they just, if they have the ability to spend to print the money in which their debt and obligations is denominated, they print the money, and you end up with a worthless currency as you fight inflation. Now that, if you have a gold standard, you can't do that. Why did we go off the gold standard domestically back in the 30s? That's because Franklin Roosevelt was in a circumstance that he wanted to spend money beyond what he could generate otherwise, and he couldn't do it with a gold standard. That was fairly straightforward. And where he put us effectively on the debt standard, Richard Nixon finished the job in the early 70s by closing the gold window, where the international exchangeability of gold for settling accounts between countries was eliminated. So that the system was set then to run on inflation, and it's been inflation driven. But come that crash in 2008, you had really a day of reckoning. All the problems ranging from the extraordinary deficits to the collapsing economic growth. The economy was already in collapse then. Insolvency in the banking system. What did they do? Everything they possibly could do without consideration for the future. They just did whatever they had to do to keep the system afloat. And they borrowed money, they spent money, they bailed out companies, they guaranteed everything they had to guarantee. They did whatever they had to do to keep the system from collapsing. I can understand that. Problem was that they did nothing. Well, that pushed the crisis into the future some. They did nothing to fundamentally address the underlying problems. We still have the budgets still going further out of control. The economy has not recovered. The banking system's a little healthier, but boy, it sure is not the way it used to be, and far from normal. And the global system is very shaky. So what's happened is we're now coming up on. Okay, they kicked the can down the road, and guess what? As we're walking down the road here, there's that can again. But you don't have the ability to kick it the way you used to. And that's a real serious problem. And going forward here, my betting is that, again, rather than letting the system collapse, they're going to do everything they can to bail it out, which will become very inflationary.
Here's the can again. I love that, and they're getting ready to kick it.
I'm sorry, I missed what you were saying there.
I just repeated what you said. You said, here's the can again, and they're getting ready to kick it. And I love that analogy because I think you're so right. And, a lot of popular economists out there are pointing to the fact that we're 40 years out from the last monetary shift. And we're in every 40 years, we've seen a shift for, a very long time in the monetary system, and we're kind of there. Do you think we're going to see a shift in the dollar in the near future?
Absolutely, because what I see happening here, there are people out there that are predicting we're going to see a great deflation, and this will come about because of debt collapse and bank collapses and such. I'm sure there are going to be very difficult times ahead. I'm sure you're going to see defaults, and you're probably going to see big banks on the brink again. But the decision to not let the system collapse was made back in 2008. And I think the central banks are going to do whatever they have to do to keep the system afloat, which is going to mean continuing bailouts, and eventually you start to see that in the debasement of the money. Now, getting to your question on the gold standard, let's just throw all this junk aside and start fresh. We're going to go on a gold standard and the monetary discipline. Well, that's a fine idea in principle. The problem remains. You first have to correct the underlying problems. There's no way we can escape the underlying problems. If we've just right now imposed a gold standard on the United States, but we left in place our deficit spending, we'd find that we couldn't meet our obligations. So that what we'd have to do is either bring our house into fiscal balance. That's what needs to be done. Or we keep devaluing the dollar against gold in order to be able to spend the money that we couldn't cover otherwise. In order for the gold standard to work, you have to have your basic fiscal conditions in balance. You get that done, then you can move to a gold standard, and that will impose its control on you. Which is why Roosevelt wanted to ban it, because he had an emergency as he viewed it, and he had to get beyond the limits of the gold standard. But
so
without getting your house in order, it won't work. It'll be forced.
What good is a gold standard if they could just get off of it?
I'm sorry?
My question would be, what good is a gold standard if they could just get off of it, if they have that option, like we've seen in the past?
That's you have to have the people behind it, and I think what's going to happen here in the future, as the system continues to suffer all the turmoil, and assuming they've got to continue to bail out the system, which I think is where we're heading, you are going to see a continuing debasement of global currencies, particularly the dollar. The dollar has been very strong in the last year and a half, a little more than that, extraordinarily strong. All sorts of factors behind that. One of the primary reasons has been the expectation of the U.S. backing off its quantitative easing and raising interest rates. And after an extraordinarily painful process, I've never seen the Fed have to think so much about what they're going to do. They finally raised rates by a quarter point, and now they're talking about holding back on it. You're not going to see anything happening here in terms of further Fed rate increases, most likely until after the election. All sorts of factors behind that, including the political, as you get further into 2016. But the effect there is that you begun to see some selling pressure on the dollar, and with that some rally in gold. And gold is going to be the general asset that people are going to flee to as they see the global finances continue to deteriorate, and the central banks moving towards ever funding whatever they have to do to try and prevent a systemic collapse. And what you end up with is debased currencies, debased dollar, that eventually becomes worthless. And when that happens, you have all sorts of problems. You have a financial crisis that comes from the hyperinflation, and it is out of that I would fully expect that you would end up with a system that has some kind of a basis in gold or a gold standard, so as to prevent that type of thing from happening again. That's where I would see it happening. You have to get, number one, get the public behind it, but number two, you also have to have the system in a manner and a form whereby it will work under the system and not be continuously